right, guys, welcome to another Viking Capital webinar. I'm really excited. My name is Vikram Raya, founder and principal at Viking Capital. I am joined here by my all-star crew and team members. I got Chris Perinello, we got Judah Fold. Guys, welcome to the show. Judah, you were in Tampa. What's the sense of people out there in terms of real estate? And Chris, you did a West Coast trip to see some of our investors and see some of the assets that we're thinking about looking at in different parts of the country. What's a good sense that either of you got?
Yeah, I mean, I'll tell you, there's a heightened awareness to where we are in the market right now, between the Fed giving implications of starting to hopefully cut rates, between looking at all the rents in the markets. And Tampa is a great example because Tampa had the height of the growth when things were really at the top of the market. It slowed down tremendously when things kind of flipped the other way. And they're just starting to see rent growth again. People still moving in, all the fundamentals, the multifamily is still there. So there's this real feeling in the market, both on the tenant side, on the ownership side, that things are starting to turn the corner, which is great to see.
Awesome. Chris, what did you guys, when you talked to some of the investors out in the West Coast?
Similar sentiment. People are, from the investor perspective, they're trying to figure out, when should I jump in? We see the interest rates are going to come down. We understand how that's going to affect cap rates. When's the best time? So a lot of my conversations have been revolving around that. And I know we're going to cover a lot of that today on the show.
Awesome. All right, Ashley, let's get the thing started here. I want to deliver for our valued investors who are joining us here. And guys, before we get started, just do me a favor. I love to see the representation on the call. Drop in the chat box, maybe where you're from. I'm super pumped to see where all our investors live all over the country. And I have a very interesting slide. I want to show you a couple of slides down where we talk about the representation of our investor base. Awesome. Vinay, you're in Atlanta, man. Welcome. Kunal, Atlanta. We got Neil in Raleigh. I got San Antonio with Becky. George is in Nashville. The DMV area, Sandra. Amber's in Ohio. Awesome, guys. Good. We got the Midwest, the South, the North, the East, all of it. Fantastic. So, guys, if you know a little about us, a lot of this webinar is mainly made for our internal investors, and so you guys are going to get first dibs at this opportunity that we're going to present tonight. But just a quick reminder for some of the new people who are joining us. And again, I want to thank you to all the investors who worked with us over the past 9 years and been part of the Viking family. We value, we appreciate you, we cherish you, we want to honor you, and anything we can do to help you succeed in your financial journey, you've got our attention, and whatever else we can do to help. That being said, Viking Capital was founded by myself and my partner Ravi Gupta in 2015, and our goal was to really, provide, outstanding income, appreciation, capital preservation, tax benefits, all of it. So I couldn't have done all of this without an amazing team. And one of the pillars of that team is Judah. So Judah is an attorney by training, but really a real estate investor by heart. And he has really led our acquisitions team to acquiring these 26, probably now 27, 28 assets we've acquired all across the country. So, and then our next team member who I want to highlight is Chris Perinello. Chris came to us from an institutional background, really did some major things with another group in the Miami area. He's worked internationally. He's worked in the West Coast, managing large funds, and he has now come across and really revamped our investor relations department. So if you have a chance, you want to talk to this gentleman. He is number one, an educator and a teacher, and number two, he's an investor relations person. So we really value the education we provide to all our investors, sometimes even not for our own assets. We're helping educate people to decide other investments. So that's really, our goal here, to provide super powerful education that you can take action on. All right, let's go to the next slide. And you guys know me, cardiologist by training, entrepreneur by heart. I've started several companies, all have hit the 7-figure mark and 8-figure marks. And now we're hitting, this is an old slide, we're at about $800 million of assets for Viking. We've had about $250 million of private equity from all our different investors across the country. And, we continue to grow. So let's go to the next slide. As we've grown in Viking, one of the things that made us successful is really having a dedicated sort of powerful pillars. And so we have one of the best asset managers we picked up in the last 12 months with Ed. He's really up-leveled our asset management capabilities. Ashley is our director of marketing. You've met Judah and you've met Chris. And then now our strategic planner is Nathan. Amir's investor relations. We got Amber, an investor concierge, and we have a financial powerhouse in charity. So really, the goal is to provide our investor base with sort of a 360-degree full power suite of sort of executive power, so they can feel comfortable navigating the complexities of real estate and of investing. Let's go to the next slide. So now we're going to discuss portfolio performance. And so I want to take a moment. Normally, I'm a big guy in offense. I love growing. I love, scaling things. But I want to take a moment and talk about how Viking is actually also good at defense. We're phenomenal in protecting people's capital. We've never lost a single dollar. We've never done any capital calls, and we really focus on capital preservation. Has everything we've done go according to plan? Absolutely not. But overall, we are on an upward trajectory in probably most of the things we're doing. And everything we're doing is for the protection and the growth of our investors' capital. Next slide. So a little bit of our track record. I think it's 26 properties now, 800 million, over 5,000 units acquired, and our 9 exits have hit a 24% average annual return. So this is the slide I wanted to focus on. So 94, we've had investors in literally every state of the country except for, I think we're missing, what is it? Idaho, guys, and Alaska. So if you know any investors there, we'd love to make this all orange one of these days. And
Yeah,
Chris,
I've been traveling a lot to meet with a lot of you folks one-on-one. If I've met with you, it's been so fantastic. I'm really making that a priority over the next few quarters. So if you're interested in meeting in person, grabbing a coffee, grabbing a lunch, please reach out, and we'll try to make it out to your area.
Awesome. Yeah. And we're hosting more investor events, happy hours, dinners, because the goal is really to get on the ground and meet with people where they are. And I think that's it's a good relationship building strategy. Let's go to the next slide. So quickly before I release our latest deal, which I'm super excited about, I'm going to just quickly have some of the market dynamics of what we're seeing. Next slide. So in the Wall Street Journal, this came out, there's never been a worse time to buy, right? Which essentially bolsters rental demand. The premium to buy a U.S. home versus renting it is the hugest discrepancy we've seen in so long. And so until they really dramatically reduce rates, it will still be a renter's market for a long period of time. Next slide. Yeah. One of the most powerful things about real estate and even multifamily specifically is the fact that it's a hedge against inflation, right? As inflation increases, which happened when they put trillions into our economy and increased the money supply in 2021, from 2021 to 2022 or 2023, this is when inflation increased the most. And that is really when we noticed all the asset prices also go up in value, and specifically multifamily is one of them. And so what that shows is if your money is in one of these assets, regardless of what happens to inflation, your money is protected. The value of your money is protected. If the same money perhaps was in a cash account, it wouldn't store that value. And so that's why we really think inflation is a very powerful driver of multifamily pricing. Okay, guys, who is driving the market next? There are some demographic changes I want to bring to light. The millennial generation is in the prime rental age right now. So they are a little bit later in buying their first home, and they are opting to rent longer than the previous generation. And, you can see the percentages, 20 to 34-year-olds, rentals, 63%, 35 to 44-year-olds, 39%. So still very high. All these, the working from home, remote working, the millennial situation, the migration to the Sun Belt, and then the inaffordable housing, all is creating sort of this rental tsunami. And then from the 2008 to the 2010 crisis that happened, a decade earlier, builders in general have been gun shy. And there's essentially still a 5 million unit shortage in the country of housing. Next slide. One of the things we see in apartment multifamily dynamics is when income increases compared to rent, what that means is it's easier for renters to afford newer, nicer, or upgraded apartments. And so we like to see when wages outpace rents. It's a healthy sign in the rental market. So now the question really comes, what happens to cap rates? What happens to interest rates? What happens to the Fed fund rate? Well, according to most projections in some of the top economists, some of the top federal agencies, they're predicting interest rate cuts to happen late 2024, early 2025. And these rates cuts will persist until probably 26 to 27, where they will stabilize. And then maybe in 27, 28, they will flatten and potentially go back up. So what that means is we know where the trend is going in real estate and multifamily. And usually when we see interest rates drop, what happens is that cap rates usually compress. So that there's a correlation we've seen time and time again, and that bodes well for any real estate that we're acquiring. But we're very conservative and we usually try to include cap rate expansions on our exits. Next.
Jumping in here real quick, Vic. I think one thing that I always make sure when I'm talking to everybody, and I would really make the argument that most investors that I talk to are hoping that interest rates will come down. They're looking at it as when interest rates come down, it'll be okay. And we know that the Fed signaled that that's going to happen. But I would make the argument from an acquisitions perspective and for companies like Viking Capital, interest rates staying elevated are going to bring us the opportunities like we have today. So we're able to find these really large discounts, and the longer that persists, the more great deals we're going to be buying. And that's why you're going to see over the next several months that we're buying a lot of properties that we can get at the basis that we can get today because the interest rates are so high.
Yeah. So, and that segues perfectly into what I'm trying to buy. This is Viking's buying strategy. So in common modern market cycle theory, there's four types of stages. There's a buyer's market stage 2, seller's market stage 1, seller's market stage 2, and buyer's market phase 1. So what that really means is there are repeatable, replicatable cycles that we can understand and benefit from. And I'll talk about sort of the last two phases here because that's really what applies to what's going on. Seller's market stage 2 is it's at the peak of the market. People are trying to cash out quickly, and it's an unsafe time to buy. But if you buy, make sure it's a really exceptional deal. And then usually there's a downturn of some sort. And then as things recover, it becomes a buyer's market stage 1 where the people who are in the know are starting to buy, but most people are sitting on the sidelines waiting. And the people who buy, they're buying because the basis makes sense, or there's huge cash flow, or there's both. And that's exactly what's happening with this particular scenario. We're finding that the basis we're getting this deal at is amazing, and there's strong cash flow, which we haven't seen this kind of cash flow in, I would say 12 to 24 months.
Yeah. At the risk of foreshadowing, right? We're seeing right now, in the hundred deals about we see a month. We're seeing A areas, B properties. You're lucky if you can get a deal into the mid-5 cap range. You want a C area, you want a riskier area, you're starting to see deals approach a 6 cap, right? That's the part of the market cycle that we're presently in, and it's very tough to find one of those that pencils strongly. So that's where we are, and as we'll discuss in a moment, the deal we're about to launch our investor base is kind of ahead of its time in the opportunity.
Next. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the actual corrections themselves. Peter Lynch. So, part is we're trying to time the market, or we're not trying to time the market, or we're looking at each deal individually and forgetting the market and looking at the fundamentals. And so sometimes it's a little bit of all of that. So next. And so I'm so excited now to present our latest deal, Dawson Forest. This is our 26th investment offering, and it's one of the deals that our whole team has been so excited about because it came through us through fortuitous meetings. It's sort of off market. It was already being marketed. It was under contract, and we were able to come into it at a very prime position. And, it is a well-kept property, 1998 built, almost 2000 built, located in the northern Georgia suburb, northern Atlanta suburb, right on a main corridor, 400 North. And it is well kept, well maintained, absolutely impeccable in terms of the exteriors, and it really has an opportunity for us to do a real value interior value add. And we're excited about the location. It's next to some premium luxury retail, which we're going to show you in a second. And the numbers, man, the numbers are just popping off the wall. And so that's exactly why we're really pleased to show this to you guys and get you guys to join us on the opportunity. Next slide. And not to be confused, these are to my not millennials, Gen X's maybe. I don't know what generation this is, but Dawson's Creek, not Dawson's Creek, it's Dawson's Forest. So remember that, okay? Next. And very clean, well-kept property. I just want to lay down my thoughts on this deal and why I love it, and I'm sure why the team loves it too. And we'll get their thoughts as well. But I love the vintage. I love the 1999 vintage. This is nice. This is a great vintage. Essentially, it's a 2000 vintage. It's the perfect size, 268 units. What this means is institutional properties, institutional owners or buyers in the future will love this asset because it fits their buy box. All the roofs have been done. So all the main things, the exteriors have been repainted. Everything looks amazing on the outside. What that does is it allows us to use our precious CapEx money to invest in revenue generating income projects on the property and revenue generating value add. So every dollar we put in will somehow push the NOI up and push income up. The location is great. It's on 400 North, and the 400 North is a technology corridor. There are 16,000 businesses from Alpharetta to Douglasville. That's 200,000 employees that are looking for places to rent because they can't afford homes, right? Dawson itself, the city, the sub-market that this is in north of Atlanta, has been growing at a clip of 20% growth. When they built this deal, it was low density. There was not much around it. And essentially it was just the outlet mall and this property. Now there's almost a huge city that's sprung up around this thing. And so in the last 20 years, it's just become a sort of a growth, a crazy growth trajectory. The interiors, about I would say 60 to 70% are essentially classics. And that's what we're going to upgrade. We're going to infuse strategic money into very specific revenue generating value add. And we're going to literally up level this whole thing. The competition is there's only 3 or 4 main apartment complexes here. They're all built recently. They're all A class, A plus. And this is the only B class property there. And so this is the only affordable solution. But there's a $400 to $500, maybe even $600 rent gap between the two. And they're already proving by doing some renovations, they're getting a $300 rent bump. We haven't even marketed that or underwrote that in our underwriting. We've done, a lesser version of that. So these are all the reasons why I really, really like this property. And I think it's going to be one of our strongest performing properties that we've ever taken on. And let me go to the next slide and talk to you about my last favorable thing about this. So the leadership team that currently is taking this project over, the whisper or the guidance price by the brokers for this deal was $58 million. That's what they thought it was going to trade at. They ended up selling it for close to like about 54 million. And then through keen negotiating by some of our, the leadership team, they were able to get it down to 52 million. That's a $6 million discount. And essentially this 11% off, full price. And so that allows us to now give you a 6 cap with this kind of market dynamics, which is unheard of, especially in Atlanta right now. And the last thing I forgot to mention is it's across the street from a luxury premium outlet. I'm talking about Gucci, Prada, Fendi, you name it. It's all right across the street. Literally, you can throw a football from our parking lot into the outlet mall's parking lot. All right, I think I can just walk away from this property. I'm done. I mean, project. I'm done. I'm ready to like open up the chat lines, but no, let's keep going. The Viking Capital unfair advantage is this. We own 9 properties in Atlanta, so we have economies of scale. We know this is a high quality asset. We have a strong relationship with the property management group that was already managing this, and they're going to just transition over and then do more of our Viking Capital style and strategy that we've already shown that works in Atlanta. And we've talked about the value add. So yeah, this is ready to go. Let's go to the next one. Can we go to the next slide? So
right.
Is this you, Judah?
Yeah, happy to jump in here, Vic. No problem. Yeah, so a couple of things I want to add from this slide and give a little more context here. So mentioned earlier that, in Atlanta today and the country as a whole, in this quality of an asset, you'd be lucky to get a 5.5 cap. This will coming in at it's actually both a T3, but also even a T12 six cap. Essentially, this is already proved out for the long haul to be a lower risk profile. Earning 6% as a cap rate is something you haven't seen probably in Atlanta in, I don't know, at least 7 or 8 years. On the flip side, we're now the beneficiary, though, of rates having come down a little bit as well. So we're looking at a very solidly leveraged loan at sub 6%. So we have positive leverage at the highest rate of return on a property we've seen in a long time. Additionally, this thing is 96% occupied. That's because, as Vic said, it is the only low-cost, affordable rental option in the market. The other properties that have come in the last few years, while they've proven out the appetite for housing, they've proven out the stomach of this market for higher rents, all to do is solidify this property as being highly occupied because everyone wants to get in. It's still a nice property. B plus, great amenities, well maintained, great size units, but $400 to $500 less than the other apartments there. DSCR here is strong. This is a safer investment for a number of reasons. One of them being the debt service well below the money that's produced on a monthly and annual basis by the property. Looking to hold it 5 years, and we'll get into all the classes of investments soon. Chris will take that away. But I want to make sure we highlighted the cash flowing, low risk nature of this asset.
Thanks, Judah.
Yeah. Now, I'll just hit up the unit mix quickly. Again, we've spoken numerous times at a flight to quality, which encompasses a few different factors. It encompasses the quality of the asset in terms of the finishings and the age of construction. As a 98 build, this is a relatively newer property. Repainted last year, new roofs in 2018. There are no leaks. It's attractive when you tour it. It's got a great clubhouse. It's got beautiful amenities. It's got a little almost like hiking trail in it as well. Certainly there's that quality. Additionally, look at the size of the units. They're over 1,000 square feet with 2/3, 2 and 3 bedrooms. You have large properties. Families can live here. You have a whole broad diversity in terms of age groups and tenant types that we like to see, as all that diversity in the tenant base greatly reduces the risk. One thing that got me excited, I know it all got Vic excited, but if you look on the left here where it has those blue arrows, whereas in the last 6 to 12 months, a lot of markets, including Atlanta, saw almost just flatline rent, this property saw 5% rent tradeouts. That means where rents across Atlanta were staying flat, rents here were still growing. And that's attributed to the just really strong velocity of population and job growth that you've seen in this market. Now, we own in Woodstock, also a far north submarket. That's also one of the other properties of ours that has seen the strongest rent growths. So we have decided to kind of double down, get another property in a similar market in order to kind of drive more of that success. All right, Chris, take it away.
Next slide.
All right, Chris.
Yeah, so we're going to talk about the Viking return options. This is an exclusive webinar for you, our investors, who know a lot about how we do things. But quickly to go through it, if you look at the capital stack, you're looking at about $35.8 million in agency debt. You have $11 million of pref. This is going to be a little bit flexible as we tie this, make this whole. We'll update you guys. And then $13.8 million of equity. The returns, that's what in these webinars, few deals. And usually you don't have a very risk-averse asset and stellar returns. This is one of those cases where we really managed to provide that for you. So you have Class A. One thing of note is that we did increase Class A, the preferred return, from 9%, like it was in the last few deals, back to 10%. So you're going to have your 1.5x equity multiple and the 10% cash on cash and IRR. For Class B, this is where you see things shift a little bit. So the last few deals, it's been 1.6 to 1.8. We're able to project 1.9 to 2.1x on this deal from an equity multiple perspective, with an average cash on cash of 5.7 and an IRR of 16%. We don't have it on here, but the average annual return for B is 18 to 20%. Reserve class, you're getting that extra point in the pref, further protecting yourself and offering more risk mitigation. And you're getting a stronger equity multiple with that extra 10% of Viking shares being given to you for the larger investment. So a 2.1 to a 2.3. Cash on cash stays the same. So you're pursue with Class B. And the IRR is 17, almost. Yeah, here what we're doing is we're walking you through a $100,000 investment. You guys have seen this before. Class A is pretty standard. You're getting that $10,000 per year. And then at year 5 or earlier when we dispose, you're getting your principal back, and you've already received your $50,000 in your cash on cash distributions. Class B, you're going to be getting 4.5% in year 1. We anticipate 5% in year 2, 6% in year 3, and 6% in years 4, and 7% in year 5. So with that equity split at 70-30, your 2x looks like this, where you're getting 72,500 on the back end. You've already received your cash on cash distributions, and you get your return of principal. For reserve class, it's just the same thing, but more enhanced. So you're getting that extra 10% on the back end, which gets you basically a $600,000 return on your investment.
And so let me answer a quick pertinent question to this. If investing in Class A, do LPs still get the benefit of depreciation?
Yes, absolutely.
Awesome.
So all 3 classes get depreciation, and it all comes in equally across all of the common equity. So tax benefits and bonus depreciation. So as we've talked about in the last few webinars, there's been a step down, and we've gone from 100 to 80 last year. This year we're in 60%. So we're operating on the assumption that this is what we're going to be. However, on the next slide, a lot of you may not have heard, but the government has tentatively approved a reauthorization of 100%. So right now it's been approved by the House. There's bipartisan support for this bill. The Republicans and the Democrats, fought pretty hardly on this. And after compromising and giving the child tax credit, it looks like this has all of the support it needs to get through the Senate as well. It didn't happen before tax time, which is a little disappointing, but we believe that this is going to get done, and it's just a matter of when, not if. Next slide.
Great. Thanks,
Sure.
Chris. So as mentioned earlier, we've gotten early indication from our lender. They're unsurprisingly also thrilled to see this opportunity. So we've got a very favorable loan quote of close to 36 million, hitting close to that 70% LTV mark that we always do target. And we haven't really seen that in a bit of time. And again, the higher the cap rate, the higher the cash flow, the higher the DSCR, the more comfortable the agencies get to that, 70 or higher than 70% leverage. Again, rates have kind of dipped down from where they were 3, 4, 5 months ago. Yes, they change a little bit every day, but we're in a good position on this one. We're getting a fixed rate loan, 30-year amortization, 2 years of interest only payments where we can really ramp up our business plan, all very much in favor of what we have planned at Dawson Forest. And a sensitivity analysis. I mean, this is one thing that Viking has regularly done in order to say, here's what we project, but each one of you might have a little bit of a different opinion as to, what the exit cap rate might be. You might want to say, hey, let's say things shift a little bit from where they project them. Where might we be here? So again, we've projected exiting this at a 5.5 cap. Historically, Atlanta has been probably closer to a 5 cap. And these are kind of the string of IRRs based on that. Look at this more closely when you have a chance. You'll have an opportunity to review these in the replay as well. All right, now this is kind of where I earn my keep. This is what I get to show off. This is what gets me so excited. For Vic, it's the tremendous opportunity and the beautiful property. Chris loves helping investors. For me, it comes down to spreadsheets. What can I say? I just love them. So here's where really kind of this all drills down to. From year one of a $3.5 million net operating income to once we continue the natural trade outs of $139 per lease, which we're seeing without doing any work at all. Layer on top of that, what Vic described earlier, which is the interior renovation plan, we'll be able to put every dollar into. We're getting $1 million, 1.2 really, of NOI growth over 5 years. That at our exit cap rate is $22 million of value. There is a lot of meat here, a lot of meat on the bone. That's the opportunity here. The sensitivity analysis of a couple of slides ago, which you should review, shows that no matter where the market goes, there's a wide range of outcomes where this is a successful investment. So God is very excited about this. And anybody who wants to dive more into the spreadsheets, book a call, get with Chris, he'll loop me in, and I'm happy to chat about it.
Yeah, we've been doing something special, guys. It's called a pro forma review, where we actually go through the numbers in person with you guys, not in person, but Zoom with you guys, and we break it all down. And so it really helps people who are, they're excited, but they want to get some of the details, and all their questions get answered. And Chris does a phenomenal job of doing that for folks. So please book a call. It also helps enhance your investor education, which is what we really care about.
And let me take a quick pause here and I'll go over this slide a little bit, but this kind of demonstrates, you see the different renovations that have been done. The seller here uses the same property management firm that we do. That alone has decreased the risk tremendously. When we bought some other properties, there were no real skeletons in the closet. We had that high level of information from before we bought the property because we share that team, we share that pool of information, and it makes for a seamless transition. They're not going to do anything that they're going to have to deal with on day one of our operation because they're still going to be the boots on the ground. Add to that another very important fact here. Here, this deal was originally marketed. Again, Vic mentioned it was under contract at $54 million. It was then brought to us at a reduced price of $52 million after DD was completed. So when we first looked at this property, we had exponentially more information than we would ever have to underwrite a property because of how far along it was in the DD process. Again, all that goes to reduce the risk that we're facing, that we see, that we could pass along to our investors in doing the deal. When we see different renovation levels here, we had intimate knowledge of each renovation scope level, what our scope would be, and we're going to go for that fully renovated scope, again, at a higher level of detail than we would have had ever previously.
All right, let's keep going.
And here's just a really quick snapshot. You can kind of see what those levels are. The classic units, there's 93 on the left. I mean, when you look at them, even compared to the partially renovated ones, I mean, you can see how dated they are. Unsurprisingly, tenants are willing to pay a very nice premium, either $175 or even would actually have been proven on site, actually north of $300. We've just been conservative in penciling in $250, but tenants have proven the ability to pay a lot more for that renovated unit. Additionally, a number of units still don't have washer dryers in them. That was a business plan started by the seller. We will bring that to full fruition and put them all the units. All that generates revenue. This is what Vic described as income generating investment money. Now that the exteriors, the roof, the paint, that's all done, we can focus here. Some more pictures, we can keep moving here. And this is what the renovated unit looks like already.
Go back one.
Yeah, back one. This is what the renovated unit looks like right now. It is a highly attractive unit, highly functional, stainless steel, shaker cabinets, a nice backsplash, plank flooring. It really nearly matches the interior of those newly built product that we mentioned earlier. And all we have to do is draft them by hundreds of dollars, and we still will see rental increases on site here. It's a lot of opportunity.
And what is the I'm getting some questions in the chat, guys, and thanks for being active and participating, guys. We really appreciate it. It makes it more fun for us as well. They're asking, hey, what's the rehab budget or what's the capex budget look like?
Oh yeah, sure. And it was on that slide addressed to you, about 17,000 to bring a unit from the classic to the fully renovated status, and about 9,000 to take that partially renovated unit. It already has cabinets done. It already has flooring done. We just have to kind of add some of the lighter finishes to it in order to bring to that full rental scope. Put on a 175 or a 250 premium, and even though they're seeing 300 plus, and that's a very nice ROI for those spends. Here's a snapshot of the property. It's already got a fitness center. It's got a massive, beautiful clubhouse. We have budgeted a nice budget to refresh it, open up some walls, make it a little lighter, make it more inviting. The bones are great. It's beautiful as is. But again, our goal here is to make, like we always do, make the upgrades at a cost-efficient basis necessary in order to attract the tenants that will fulfill the renovation plan. Again, here are some ideas of what we're doing in the clubhouse. What you just saw, very tasteful, but it looks like it's about 20 years old, to really modernize the clubhouse, to really match the high-level scope that we're seeing and continuing in the interiors. Again, great amenities here, a pool. There's really a beautiful sport court and playground. Again, we have a wide variety of ages, a lot of pets. There's a dog park, and the amenities on site already that have been renovated by the seller really do match the wide variety of tenants on site. All that does is to appeal to the widest array of tenants possible, therefore reducing the risk of attracting tenants. We can keep going. And now the interior amenities also, again, what's already in place is very competitive. We'll simply be up-leveling it all. And this goes to what Vic was talking about before, the retail that is surrounding all around it. That's one of those on the left, I believe, is a Home Depot. The other is more kind of retail. And just to the right of the screen, where those nice berry bushes are on the kind of the right side, you start to hit all the premium outlets. Don't take my word for it. That's literally what they're called. The high-level shops that attract not just shoppers as it used to, but now actually people who want to live near it as well.
And I want to stack on what Judah's saying, guys. Look, there's a Home Depot, and then there's a super Walmart here, and then these are the super luxury premium outlets. So what I want to point out is these companies, who are a lot bigger than us, have done fantastic demographic studies and decided to put one of their retail stores here. And they knew that because of growth, because of demographics, because of traffic volume. And so this just reaffirms our decision to own an apartment complex in the midst of this retail hub all along the main artery of 400 North. So there's about $700,000, 700,000 square feet of retail space that's surrounding Dawson Forest.
Again, mentioned before the flight to quality, large floor plans, the one bedroom, that's pretty large for one bedroom. The rest of them all north of 1,000 square feet. It's why it attracts so many tenants. And then in rent comparison, here's kind of what we were describing earlier. In every floor plan, there is plenty of headroom towards the comp set. We really have the opportunity here to draft behind more expensive product, stay fully occupied, offer a very nice apartment for people to live in. Viking takes pride in our properties. We take pride in what we can provide to our tenants. And the fact that we can do all that while also increasing revenue and benefiting our investors is really the balance that we strive for.
Okay. So one of the things I'd like to highlight is within a 3 square mile radius, it's between 90 to about $120,000 of annual income in the area. We're still doing our due diligence, and so we'll find out, the income on the property. Do you have any early data on that, Judah, on the income on the property?
Yeah, it's north of 70,000, which for the tenant population is strong. It gives you that more than that 3-to-1 ratio we like to see from income that's on site.
And then we know that it's income growth has been there, college educated population, at least a third to even potentially 40% of the population is college educated, white collar employment, young age, 38 to 41. Next slide. Dawsonville, as I mentioned, had a tremendous growth, 20% growth in demographics year after year. It's number 3 ranked for top counties in the U.S. Georgia had the 6th highest rent growth in the U.S. last year. And this is new data. This is not like, 2-3 years ago. This is just recent data. And so it shows that, again, the reason why rent growth is happening is because of demographic shifts and the migration to the Sun Belt, and specifically to an employment hub such as Atlanta. Here's the average rent ranges in different parts of Atlanta and those different submarkets. Dawsonville ranks up right up there, one of the highest, 1830 in terms of rents. And there's several counties where we own where a lot of these rents are manifesting. Strong demographics of Atlanta: 30% renter occupied, average household income 130,000, 82% white collar jobs of this the Dawson submarket. I think we've talked about this story where prior to 2018 there was no other properties, and then from 2018 to 2023 all the delivery, these 3 or 4 main apartment complexes were delivered, and that changed the rent dynamics literally 400, 500, maybe even $600 more than what we were charging at our property. So it created a new upper limit of what's possible for rents. And that made our property become officially sort of the more affordable option. And we are not trying to close that full gap. We're only trying to close a partial amount of that gap. And we're doing it with renovations. We're not just hoping we're going to get that premium. And the good thing is we've looked at the development supply, we've checked all the records, and we've talked to all the brokers and everything. There's no new supply coming online for the next 2, 3, 4 years. So what that means is we're going to continue to be the beneficiary of this rent gap and be the most affordable solution in this premium area. As a physician, this is important to me that local hospitals of high-end quality are nearby. So within a 30-minute driving distance, you have Northeast Georgia Medical Center. You have a medical plaza. There's a new tower being built at the Northeast Georgia Medical Center. So all this medical hub is being formed around our property. So that what that means is a lot of med and ed, like a lot of physicians, nurses, other kind of allied health forces that are going to be living in these properties, as well as educators, and all the universities are also nearby. We've talked about the outlets. Next. There are all these retailers and big box stores. Here's all the major employment hubs. Microsoft has a major presence here. Alcon has one of the largest office parks in all of Atlanta, has 41,000 employees. Gainesville, I did some research on this prior to the presentation, is the poultry capital of the world, my friends. So what that means is like Tyson, Purdue, all these companies, they're either distributing, processing, or having their farms there. And it's a $28 billion industry with the main epicenter right there in Gainesville. So eat chicken when you're in Georgia. Next is obviously, the story of Atlanta, busiest airport in the world, #1 metro tech hub in the Southeast, diversity, 6 million population, #1 place for doing business. And I think, it will probably be close to 7 million over the next few years. Unemployment rate is low, below 3%. Major Fortune 500 hub: Coca-Cola, Delta, UPS, Home Depot, and all these other ones as well. It's also a big medical provider: Northside Hospital, Emory University, Coca-Cola. All these places are really huge drivers. And so if you wanted to get from our property to downtown Atlanta, it's, a 45-minute drive. So it's not, it's not a crazy commute. And everything in Atlanta is usually 30 to 45 minutes anyway. And
Well,
I'm saying this because I'm from Atlanta.
They got to knew this, but Dawsonville is actually the birthplace of stock car racing. So
Okay.
it's may get there in like 25.
We know Atlanta is a hub for tourism, the Fox Theater, CNN, Georgia Aquarium, all the major sports facilities. And we want to talk about sports. I have another slide I want to emphasize here. We'll quickly do the quick aside of, $71 billion impact of the busiest airport in the world, Hartsfield-Jackson, which also has spawned a lot of industries around there. But I wanted to go back to the sports theme. The FIFA World Cup has been awarded, and Atlanta will be one of the hosts of some of the sites in 2026. And they expect that it's going to have a $17 billion impact. The Hollywood of the South is Atlanta, home to huge entertainment industry. Probably 20 studios now have called their home in Atlanta, about $4.4 billion impact. Porsche North American headquarters near Hartsfield-Jackson. We got the Rivian plant. There's a couple of gigafactories now being formed in Atlanta. Gigafactories are where they have these huge sort of city-like factories where they're producing batteries, and they're assembling these EVs. And so as the EV industry continues to climb up and most of America starts getting electrified in terms of vehicles, Atlanta is going to play a huge part in that. So next slide. Education is a big thing. So tons of universities here. And there's actually universities closer to Dawsonville as well that we didn't mention, but there's a lot of higher level education. And what that does is also creates more jobs, it creates more demand. Employers want to be here because of the educated workforce, and it's just a virtuous cycle. We can go to the next slide. So next slide. One of the interesting things about Atlanta is it's a growth catalyst because of the logistics and transportation industry. We mentioned the airport. We didn't, and I talked about this on other webinars, but really all the industrial warehouses that are there, these are smart warehouses. These are next level warehouses. These are, there's artificial intelligence, there's robots, there's all sorts of things in these warehouses. So there's a higher level of team members, employees there. The highway infrastructure in Atlanta allows anyone to go to 80% of the US within a 2-day truck drive. CSX, the largest railroad, has a big stop station here. And then there's two big ports, the Port of Brunswick and the Port of Savannah, which is very close to all of this, which drives a ton of trade through all of them.
When I was in Florida this past week, driving all around these huge industries that are on 75, around I-75 in Florida, I kept thinking to myself, these all pass through Atlanta to get to the rest of the country.
Absolutely. So as we wrap up here and we sort of get to how you guys can participate in this opportunity, I just want to show that why a track record makes sense, why economy of scale makes sense. We have 9 properties right now in Atlanta. This will be our 10th. And what that means is we've done this through different parts of our market cycle. So we understand the ebbs and flows of Atlanta. We understand the demographics. We understand the property management. We understand the tenant base. And we can share resources across properties so we can maximize NOI. And our asset managers are well equipped. We understand this market. It's not a mystery to us, and this is going to be a sort of a straightforward acquisition for us to do, and we're going to implement our typical Viking business plan. And the thing is, because the basis and the debt and the dynamics of the deal are so attractive that it really lends for this to be one of our strongest deals. Next slide. The reason for why we've chosen multifamily as the asset to focus on. We've been in this industry for almost 10 years. I've seen a lot of our colleagues switch into RV parks. They've gone into student housing. They've gone to hotels. I think there's retirement communities people are building. We've decided to stay really focused on one asset class, multifamily. Why? Because we think it's one of the safest asset classes out there. I think it appreciates over time. It hedges against inflation, the tax advantages, long-term stability. This is not a luxury asset. This is a necessity asset. There's a housing shortage. We believe in that. There's a housing shortage, and we want to provide a solution for the housing shortage. We also think that if you already are investing in portfolios and in your job and other businesses, then you should, if you're going to do real estate, why not have multifamily as one of the safest bets in real estate? And I was at a conference in Whistler where there's some billionaires that were speaking, and they were sort of, up and down on the world situation with Ukraine and Israel and Gaza and, China. And then they're saying, markets are still a little volatile in the US, but they said, if you're going to do real estate, choose one asset class, and it was multifamily. So it was good to hear reaffirming by some of the top business leaders in the world. Next slide. So multiple ways to get involved. I suggest booking a call with my IR team so they can help you decide, hey, what's the right vehicle to get involved in these projects. But just because you don't have cash ready to go, IRAs are always a great option. Next. So all right, we'll go straight to my funny slide here. Okay. So you guys know I'm a cardiologist, and I'm trying to be conservative in a lot of things and try to stress test. We try to stress test every deal. And so I was like, all right, look, I'm going to go in and give them all the amazing things about the deal, but I'm like, I don't want to just paint a rosy picture. I want to give them, hey, every deal, every entrepreneurial venture has risk, right? If there's no risk, it's hard to get any kind of reward. So what I've learned as being an entrepreneur is you don't avoid risk, you learn to mitigate risk. And so let's talk about the risks here quickly, and then we'll open it up for you guys to get into this project. But there are a couple of main risks, right? Let's call about asset risk. And so multifamily with sort of asset risk, like we're getting into real estate. So what's the risk? Well, there's so many different types of asset classes. And as I mentioned, why multifamily stands out as one of the most conservative ones there. Then there's a risk of debt, right? We've heard a lot of people have struggles over the last couple of years with debt. And so what we've done is we've figured out, hey, let's get fixed debt from an agency and protect, ourselves on this deal. And that's what we've done. So that risk has been mitigated. Then there's location risk, right? So Atlanta, obviously a strong hub. Atlanta's not going anywhere for the next decade or two. So we're safe there. And then within Atlanta, what's a strong growing submarket? Well, we have Dawsonville, right? Boom. Then there's operation or execution risk. So, we've done, we're on track to eventually be at close to 30 multifamily acquisitions. We have almost $1 billion of assets we've acquired, right? And we've worked with the same property management company, and we have a core team that's been together for a while. So execution risk is mitigated. Then we talk about the age of the property. That's a risk, right? The vintage. Well, this is a 99, almost 2000 property. That offsets that. Then there's what about competition of other rent apartments? Well, we know there's no new supply. That's safe. And number two is everything above us is $400, $500 more than us. So we don't have to worry about them because they're the A-class property. We're not competing with them. We're going to trail behind them appropriately. Then what about, shopping, retail, other kind of things around? Well, we know that's taken care of. Then there's timing risk, right? Well, we're buying it at the highest interest rate available right now. We knowing that interest rates are going to drop. There's less competition, so we got it at a discount. And we suspect that the next 2 or 3 years will be more sort of bullish than bearish. And so that's another way we can protect our risk. So, and then the last thing is due diligence, right? So we did our own due diligence. We have a company the property management company doing due diligence with us, and we've checked out everything. So there's no hidden surprises that we can find out right now. So all of this has given us a reassurance that this is really going to be a strong deal. And the final thing is sale risk. This is an institutional quality deal with, it's a B plus that we're going to eventually convert to a sort of an A minus. And it's in a good location, a good vintage. And so an institution will want to buy this probably from us on exit. And so with all that said, we can go to the last slide. This is our track record in the next slide. We encourage you guys to join us on this project. We've already had, I think, a couple of million of dollars of interest already in this project. It's probably going to oversubscribe because of the returns, because of the location, because of the vintage, everything we've mentioned. So I really encourage you to get your questions answered by Chris, by Amir, by Amber, and our team. Put in the chat box below, scan the QR code, talk to our team. If you want to get on a call with Judah and myself, we're always available as well. But the key here is get your questions answered. Make sure that this fits into your investment thesis and your financial freedom game plan, and let us help you get there quicker and take advantage of this deal. As you know, there's not that many people doing deals right now. And so this is one of those diamond in the roughs that we found, and we want to share with you guys. So please join us. Super excited, super pumped.
Reminder for everybody that this is the kind of the Viking family exclusive webinar. There will be another webinar. There'll be this expansive Q&A because there won't be enough time to talk to everyone individually. Please, if you have any questions, reach out to us. Book a call. There's so much information we couldn't even squeeze into this webinar. They're expanding the highway, miles and miles past Dawsonville because of the progress. Yesterday, we just found out that we're going to have like a $27,000 per year insurance savings. That's going to save us over $1 million through the life of the investment. There's so much more we can tell you. We just literally couldn't fit it all into this webinar. Any questions, more information, use a QR code, book a call. We'd love to share it with you.
Yeah. And then this is a Viking investor only webinar. Next week, we're going to do one where we release it to the general public. So my recommendation is secure your slot before we broadcast it broadly. Chris, any last words?
Yeah, please do book a call. I'm available to go through the pro forma, really dive into the underwriting, and let's talk about the returns, talk about the risk, like Vic mentioned, and see if this fits into your investment thesis. Thanks,
awesome,
everybody.
Really appreciate it. And I know that you guys, a lot of people ask questions. We'll get to it in our one-on-ones, but thank you again, everyone. All right, guys. Good night. Enjoy your evening.